Okay, and then need to go ahead and accept that. And let me go ahead and put up the slides for tonight. I know that we had that first part, what I was calling part 4A, for chapter 4. Um, and I am going to still cover those questions together, if not tonight, because I want to get through as much of the 4B material as possible. Then potentially we may cover those as we move closer to the midterm. I think there were maybe 3 or 4 questions left from that chapter 4A midterm, practice midterm. And if we have time tonight, as I said, we'll look at that. If not, we'll jump into those at another time. What I want to do is go into this chapter, what I've labeled as 4B here, you can see. And what I did with 4B part 2, however you want to look at that. What I've done with chapter 4, which walks through a variety of transactions for a governmental unit, focusing mostly on the general fund, I took it and broke it up. And remember last time in 4A part 1, we talked about revenue recognition. Now we're going to talk about the process of expending resources, talk about the budgetary encumbrance process, the establishment of the budget at the beginning of the year, and then as the entity actually begins to expend money, how that would be accounted for. So we're sort of on the other side now, the spending side. We talked about the revenue recognition side last time. I'm going to go ahead and put my machine into tablet mode and hope that it cooperates with me. If not, you guys are getting more painfully used to the drill where I have to kind of go back and reboot things, but let's see if we get away with it here as we go through and start to look at some of these slides. And boy, there's got to be something to my clicker just hiding from me. I went and got the container, took it out, have it right here. Okay, good. All right, so let's go ahead and let's just take a look at some of these slides. And what we're going to see is we're going to be setting up our budget, and we're going to be setting up our budget at the beginning of the year. We'll use that to account for transactions during the year, and then we will go ahead and close those budgetary accounts at the end of the year. Now, the budgetary accounts, remember, as we're looking, are at the fund level, and we're really talking about the governmental funds and primarily the general fund as we go through this. Now, as you're probably aware, there are various accounts that are budgetary accounts for our revenues that we think are going to be coming in during the year. We have something called estimated revenues. If we have other financing sources, remember our other financing sources are long-term debt proceeds and transfers in. We think we're going to be having those. We'll have estimated other financing sources, long-term debt proceeds, transfers in. For our expenditures, they're not really called estimated expenditures because they are subject to appropriation law. Generally, governments do not have the authority to spend money unless the legislature and then the executive branch agree as to what the appropriate amount of spending will be, thus the term appropriations. And that is a legal authority to spend money. So we don't call it estimated expenditure, we call it appropriation. And then if we have estimated other financing uses, we would call them such, estimated other financing uses. Now, the budgetary account that is sort of like the fund balance, I use the term budgetary control. The book uses budgetary fund balance, I think, quite a bit. I don't use that term. I use budgetary control. I follow the recommendation of the Government Finance Officer Association. GFOA has sort of cast aside this notion of budgetary fund balance. They've called it a misnomer, and they use a title for the account called budgetary control. So when you're reading the text and you see where I'm using budgetary control, You may see the book using a term like budgetary fund balance. I use the term budgetary control, but if you look at the journal entries described in the book versus what I'm having on the slides, you'll see that where the book is, say, using the term budgetary fund balance, I'm using budgetary control. We're also going to talk about the encumbrance process. And again, we're not going to use the term outstanding encumbrances that the book uses. We're going to be using, again, the account title budgetary control. And as we go through the examples tonight, I think you'll see how budgetary control is really, and I describe it almost as a workhorse in which we put amounts in the account during the year, at the beginning of the year, during the year, and then at the end of the year, we take those amounts out, and that budgetary control account is generally zeroed out by the end of the year. And that's really the approach that GFOA suggests. And maybe as we go along, we can talk a little more about how you may do it at the city and county level for San Francisco. Okay, so let's go ahead and start to take a look at these journal entries. Now, in the examples, they show us both subsidiary level and a general ledger level. I tend to focus on the general ledger level because subsidiary is just a certain amount of detail that calls out specifically what the funds are going to be spent on in this example. I'm not so much interested in that as I am the higher level GL level, the summary level entries that we're going to talk about here. So when we talk about estimated revenues, okay, this is based on what the entity is determined is going to come in the form of maybe tax revenue. You can see licenses, permits, et cetera, whatever they are. But the total of those numbers gross up to 500,000. So I'm pointing that arrow up. And so at the general ledger level, at a summary level, we would have a debit of estimated revenues. Now we debit the estimated revenues because we're going to see that our actual revenues will be a credit and allows us to keep track as to how we're moving along for our budget and getting in revenues if we debit the estimated, the budgetary account, and credit the actual as we actually receive these revenues. Now, and we don't call it estimated expenditure, but think of it as a budgetary account, our appropriation, what the legislature and the executive branches agreed as to what the governmental entity, the city, the county, the state is going to spend their money on. We go ahead and we credit appropriations. And again, you could have, it's going to do that. Hang on, guys. I'm going to have to do the annoying thing of, let's see. For some strange reason, I'm going to have to reboot the slides. No explaining, no accounting for weird things. Can't think of any reason for all this, but it is. What's the terminology you young guys use? It is what it is. So let me go ahead and do what I have to do here. Okay. This again. And, and yeah, I can't explain it to you. Okay, but you can see that the detail level down here in the appropriations ledger then rolls up to 450,000. Okay, now this is the entry that is made at the beginning of the year. Okay, and the entity here is assuming that they're going to take in more funds than they spend. If that's the case, then we would have a credit to our budgetary control account, and that would constitute a surplus, meaning we're going to have funds left over. Now, what I sort of scribbled in over here, and you can see that it could be that the government just budgets that it's going to spend more money than it's going to take in. So for example, if the estimated revenues were only 450, but our appropriation was 500,000, this government has planned to run a deficit, and it's going to run a deficit in this example of 50,000, and that deficit would go to budgetary control. Now, I think we talked in here, and I think Carmen, you had confirmed that the city must at least balance the budget and it cannot run a deficit. That's some legal requirement, statutory requirement. I don't know if that's the case, and I'm not going to ask a lot of questions.
Sorry, it is true. And we have to balance the budget.
Okay, okay, good, thank you. So if that's the case, then this wouldn't be something that you would see here. But for the federal government, for example, they run a deficit every single year. There were a couple years at the very end, and everyone always says, oh, Clinton ran a surplus the whole time he was president. No, it was the last couple years of his administration that he was able to run a surplus. After that, Bush, the son came in, and the Iraq War started, and we, all the war in the Middle East and whatever, conflict, whatever they're calling those. And we ended up with deficits ever since then. And the debt, which is the accumulation of the deficit since that time, has gone to where it was at about 5 trillion at that time to, I think I looked or heard something yesterday, it was up like 35 trillion. So by surpluses, there's been nothing but deficits since then, mounting this huge debt. There's a lot of talk now about making certain cuts to different agencies and whatnot, and I'm here to tell you that that is, the cuts that they are doing will have little effect on the deficit, and that most of the deficit comes from non-discretionary spending that they have to make for Social Security, Medicare, those sorts of things. Unless they started to hack away at the defense budget. And so it'd be interesting to see if they're going to do anything more than just fire generals as part of their shakeup of the Defense Department. But well, that remains to be seen. But as you take a look here, this government, which is the case for most state and local governments, has decided to run a surplus, and that surplus goes to budgetary control. Okay. Now, what I want to do, I'm trying to figure out the best place to do it from an efficiency standpoint. I think I'm going to just put it on this slide, okay? Where I'm going to go ahead and run a T account of this budgetary control. And I find this useful just to understand how this budgetary control account contemplated by GFOA for internal uses, by the way. This is a suggested thing from GFOA for internal uses. This is not information that's, available necessarily to the public, although we do publish some budgetary information for comparison purposes. We wouldn't go to this level of detail. But we have this budgetary control credit right there. Okay, just posting that credit of this 50,000. Okay, and I'm going to go ahead and keep track of that account as we go through this example. Now, you look, and maybe not so much in the case of this class, but in some classes, it's not the subsidiary ledger. I'm going to do it at a general ledger level. That's why I struck out subsidiary there. But you'd probably do this at a subsidiary level or even lower level. We could come up with, say, a revenues ledger, okay? And in this revenues ledger, we just debited the estimated revenue, that 500,000. And so the balance in there is 500,000. Now, let's say that this government starts to collect some licensing fees, and we're not going to get all up into the revenue recognition. They've met the criteria of eligibility, or if it's exchanged, they've given something in return, they receive some cash for it. And so we're just going to go ahead, not matriculate through, revenue collected in advance, the deferred inflow, and ultimately revenue. We're just going to jump straight to the revenue butterfly, right? So we go ahead and let's say they issue some fishing licenses here on January 31st. They go ahead, they debit cash, they credit revenue, just like you would in commercial accounting once you've earned that revenue and some cash comes in. And we go ahead then and we post that $40,000 credit to the revenue column here. And now this government can see that they have what? 460,000 left to go against collections as anticipated for their revenue. A little bit later, the next month, whatever, they go ahead, they get some more cash, some more revenue. They post that revenue, and now this government at a internal level can see, okay, we are tracking against our budget, we're collecting revenue as anticipated, etc. It's a budgeting tool. Okay, any question on that? Okay, and they would continue on like this and so forth. Now we looked at the revenue side. Let's go ahead and take a look at how we will look at the spending side, which is really more the focus of this chapter. Okay, so what happens? When this government orders something, now they're just ordering at this point, they haven't received yet, and they go ahead and they order a printer in this example, and they're going to order it out of the general fund. And so they go ahead and they debit encumbrances, they credit budgetary control for this 50,000. Now, if you go back and you look at my budgetary control account now, okay. Back to my budgetary control account, I'm going to go ahead and I'm going to post that credit there that I just did. Another 50,000 just got credited there. And it's just a coincidence, maybe not the best coincidence for understanding purposes, that that 50,000 was the same amount. That first 50,000, the second 50,000 are not related to each other. It just so happens that this printer was for $50,000. They credit budgetary control 50,000. They debit encumbrances. Now, encumbrances work to avoid overspending our appropriation authority. Okay, so we are saying, hey, we've encumbered some of our budgetary appropriations that we received. So, sort of the mirror image to what we saw for the revenues ledger. Okay, we will go ahead and set up an appropriations ledger. And if you take a look at that appropriation ledger, we had the original credit of 450. That was the appropriation when it came in. We would debit the encumbrance 50,000, and we know that we have what? 400,000 of appropriation budget authority left that we can continue to spend under this appropriation. Now, this is important because most governments have anti-deficiency laws, which say you can't encumber more than your appropriation that's available. If you do, you have run a deficiency, and that is not allowed for you to do that. Does San Francisco have anti-deficiency laws in place? Do we know?
We have to have a balanced budget, so by that definition, yeah, we wouldn't be.
I can't hear. Can you say that again?
Sorry, we have to have a balanced budget, so we wouldn't have a situation where we would have a deficiency. But I mean, I don't, it's a law of a balanced budget, which I think is similar, but it doesn't out and out say no deficiencies, because we just wouldn't have a deficiency.
Okay, so under a balanced budget amendment, I guess, is similar to an anti-deficiency law. We would probably use something like this just to make sure we're balancing the budget. We're not spending more than our appropriation at a minimum. I guess we would, maybe potentially have revenues. What if the revenues don't come in as anticipated?
So the budget office monitors and analyzes on a quarterly basis. So we would have to make cuts if the revenue doesn't come through.
I see.
To make sure we stay within limits.
Okay, I see. Yeah, and there'd be some discretionary line item that would be affected, I would imagine.
Yeah, and we'd have
Okay.
transfers.
Okay. That makes sense. Okay, good. So again, though, tracking against our spending and knowing are we actually spending what we've appropriated and whatnot, obviously in the context of the conversation we just had, would be important. So we know we still have 400,000 of budget authority, but that encumbrance sits there waiting for the actual amount of expenditure to come in. Now, going back to the slide here, when we actually receive this item, then we can go ahead and debit budgetary control for 50,000 and credit the encumbrance. Now, when we do that and we credit the encumbrance, notice what happens is the encumbrance account comes down, of course. So we've now zeroed out that encumbrance account for this particular item, of course, and we debit it with the actual amount, the actual expenditure of 50,500. So what has happened? We still have 399,500 of budget authority left, so we can continue to order under this appropriation, this line item, whatever it is, but we don't quite have as much left as we had originally anticipated. Now, if you look at the budgetary control account, since I went ahead and I had credited it there and I debited it there, I can go back now and I can put a debit there for that 50,000. So now I'm still left with the original credit to budgetary control that I'd set up when I anticipated a surplus at the beginning of the year. So we're going to see that as we order things, things will go into, that's why I kind of say it's like a workhorse. We put amounts on the budgetary control and it sits there for a while until what? Until we can put the actual expenditure in the appropriations ledger, and then we can take that off of the budgetary control horse at that point in time as we zero out the encumbrance as we actually receive the thing that we had ordered. So you set it up for whatever you think the thing's going to cost you, and then you go ahead and take it out at the original budgeted amount, and then you debit expenditure for the actual amount. And I'm using vouchers payable here. I guess some entities could use accounts payable. I'm using the term voucher payable. Voucher is generally a control document in which expenditures are listed, and then somebody with the appropriate authority will go ahead and approve those expenditures on a voucher. But it means that we have an amount that we're going to have to pay to a vendor or whatever it is. So later on when we pay this, we would of course debit the voucher payable and credit the cash. Any question? Okay, good. Now we go through, and as we start to describe real entries, this gets ponderous after a while, guys. Okay, now it's working. Okay, as we go through and we start to talk about real account entries, they're going to describe things happening at both the government fund level, the general fund level, which really is the focus here. They're going to show you how that transaction would look if we were to enter it directly at the government-wide level using full accrual. Remember, in the funds, we're using modified accrual. As we've stated a number of times now, we pretty much enter things using the appropriate fund accounting, say for the governmental funds, modified accrual, and then we'll convert and consolidate the financial statements from the fund level to the government-wide. In some cases, for the governmental fund accounts, we'll have to convert those from modified accrual to full accrual. Okay, but we'll show you both levels here. Now, again, the budgetary entries are only for the fund level. And so here in this example now, just changing things up a little bit, they're determining an appropriation excess. So they're sort of like the federal government here, in excess of the revenues that are going to come in. And so they're running a deficit. If you were thinking you had to spend certain amounts of money and you wanted to balance the budget, what would you do? You were thinking, hey, we pretty much got to spend this 11 million, in this example, 360. These are vital programs. These are entitlement programs. These are programs that we have to spend the money on. We think we're going to only get revenue of 10.9, whatever. We can't run a deficit. So what would you do? If you're a government and you're faced with the dilemma, we're not going to cut 11,360. We can't. We've cut this thing as thin as we can. We're only estimating revenues at 10,972. We don't want to run a deficit. What should we do?
So we would use the existing fund balance? Is that the budgetary control?
Well, you'd still be, I understand you'd be using existing fund balance, but that would be running a deficit, right? I'm assuming the deficit is for any 1 year. I mean, it wouldn't change this journal entry if I so happen to have in my fund balance, say 400,000. If my budget came true exactly as I said, then eventually I would debit the 388 and close it to fund balance, but I would have run a deficit in that given year, wouldn't I? I would have had a decrease in fund balance for that given year.
Yep.
So if the
That
law
would
is you can't run a deficit, I'm assuming that's for any 1 year.
Yeah, that is true. But and anyone can correct me if I'm wrong. But if if we do have like from prior years, maybe increased in revenues, which created a fund balance that can be used to budget fund balance as revenues to support the current year appropriations.
So then the estimated revenue would be more, right?
Yes, yeah. So it would be budgeted as additional sources in addition to the external revenues.
Okay. But what if you didn't have that? You have this.
Yeah, then you would be in a deficit, correct?
Right. So what would you do?
On the contingent of, that you
I'm
have.
talking policy standpoint.
Oh, I'm not sure. I'm just thinking like when I look at like our annual appropriation and how that would work. So I'm just speaking, but policy standpoint, I'm not sure.
Okay.
Maybe
And I think where I'm thinking, you could increase taxes. You could increase taxes. You're going to get what? Additional revenue. If you get additional revenue, then you'll take away this deficit or maybe some of this deficit anyway, right? So then you start to get into a policy discussion of raise taxes. How? How do you raise taxes? And there are a whole variety of different ways that taxes could be raised that would cause us to have less of a deficit. Now I'm talking federal level now. So if you had more revenues, you raise taxes somehow, you could have less of a deficit. And that could, be a decision that you make as you're having an increasingly aging society. And you're looking and saying, well, look, we have a short-term problem. By me calling it a short-term problem, if you consider that we are coming to the end of the baby boom, I think baby boomers were the baby boom era ended 1964. So that's 60 years. So to me, a 30-year problem, and you say, well, gee, 30 years ago, John, 30 years, that's a long time ago. I mean, 25 years ago was the year 2000 was starting, depending on your age, but that doesn't seem that long ago to me. So we're talking about a 25 to 30-year problem that's going to persist while you have baby boomers drawing on certain benefits and less people paying in. That problem will start to go away over the next, after the next 30 years or so, let's say. And so that really could be seen as a short-term problem in which you could raise taxes appropriately at the appropriate brackets and whatnot, get rid of some of that deficit so you don't keep piling this debt on. maybe take a look at some of the bigger budget items, discretionary items, but this idea of sort of playing this sort of movie of, wow, look at everything we're doing to cut the deficit and whatnot, when you're not really, to me, seems a little less than seems a little opaque to me, seems a little bit like a shell game. But anyway, end of that speech. Okay, good. So if it, and the whole point of this slide is to show you that, hey, if it was a deficit, then we would debit budgetary control as opposed to the surplus that we had a minute ago where we credited. I think in most examples that we'll look at, we'll credit budgetary control, okay, with the surplus.
And can I say something?
Yeah, sure.
Yeah, I think in cities context, we probably don't have this kind of entry because we're not allowed to. We have to balance in the beginning of the year for budget setup entries. We wouldn't have this, but at the end of the year, when we under received actual revenue versus estimated revenue, or we overspend actual expenditures over the appropriations, that would come in what Mary Carr was talking about, use fund balance to fill the hole, I think.
Yeah.
That's the situation.
Yeah, and we'll look at the closing entries as we close our actual revenues and our actual expenditures to fund balance. Again, in most of the examples that I'm going to use, we're going to actually end up with a little bit left over. But I'll show you, hey, what would happen if you didn't end up? All I'm trying to show you here, is, again, if you had a deficit, there would be a debit to budgetary control. The budgetary account is goes to credit. That's the only takeaway here. Yeah, I know that most governments don't do this. The federal government does this every year. Thus, I thought it was worth talking about. Okay, good. So let's go ahead then and let's take a look at the encumbrance process again. Okay, sure. Oh, I put that X there because I'm not really worried about subsidiary level. But again, we order supplies, we debit encumbrance, we credit this budgetary control account, okay? Now, let's go ahead, and I had started to keep track of my budgetary control account. Keep track of that account. I think this problem lets me do it. If not, I have a comprehensive problem that I'll look at with you, and that one will work out. But let's see if we can make this one. Okay, so I'm crediting my budgetary control for this 420, and I had originally, let me go back to that previous one. Oh, they had a deficit. Okay, well, hold the thought on how budgetary control zeroes out, guys, because these examples aren't going to track right for me, but I do have one that's more comprehensive, and I'll show it to you then. So debit budgetary control, debit encumbrance, credit the budgetary control for what we ordered this for. Now, when the item actually comes in, okay, then we would go ahead and debit the budgetary control, credit the encumbrance, and replace that with the actual expenditure. And here the actual expenditure was a little bit more, 432. So we debit expenditure, credit voucher payable, and then later we would, of course, debit the voucher payable and credit the cash. So again, you set it up for what you think it's going to cost you. Once it comes in, you reverse that original encumbrance entry and go ahead and debit the expenditure, credit the vouchers payable. And then for governmental activities, all they're showing you here, guys, under the dual track approach, is that we go ahead and debit the expenses as opposed to expenditure for the various government programs, general government, public safety, et cetera, and credit the voucher payable. So governmental activities at the government-wide level, general fund level for the actual activity. We wouldn't have used these budgetary accounts for our government-wide activity. Okay. Accounting for payroll, not a big deal. And that the only reason I'm leaving this slide in here is to point out this point that generally governments don't use the encumbrance process that we're talking about for salaries. those are reoccurring amounts, and generally the legislature will simply appropriate what it needs to meet payroll. Do you all use encumbrances for salaries and recurring things like interest and that sort of thing?
Don't have encumbrance for salary. We have encumbrance for purchasing materials and supplies and services.
I think I heard you say that you don't use them for salaries and you would use them in for supplies and,
Materials and supplies for services.
okay, good, yeah. So that's consistent, huh?
For any purchases other than.
Okay. Again, the microphones are cutting out a little bit, but I think what we're saying is this is correct. So for this example here, what we would do is debit the expenditures and credit, and we would probably have withholding for federal and state purposes. So we're calling those due to. I put those in red because a lot of times when there's amounts that are owed to other governments or other funds, we use the term due to. We could use, accounts payable if we wanted to, but due to is another term that you see quite a bit. And then, of course, the net pay that goes to the employees, that would come out of cash, and we would debit the expenditure for that. The key takeaway is these two due to accounts and the note down here that we didn't use encumbrance accounting for salaries. Okay. Okay, good. And then if we're at the government-wide level, we call them expenses as opposed to expenditures, and we might call out the statement of activities level accounts that we would be using. Tax anticipation notes. Okay, sometimes a government will issue these and that there's going to be some taxes coming in and they can borrow some funds on a short-term basis. Since these are short-term liabilities, very similar to commercial accounting, okay, we would go ahead and simply debit the cash that we receive and credit the tax anticipation note payable. And then as we pay that, we would debit the note and credit the cash. And if there was some interest, which there typically would be, we would debit interest expenditure at that time when we're paying off that note and interest. Okay, interfund activity. Okay, and if you take a look, we have reciprocal transfers, non-reciprocal transfers. Reciprocal transfers are when the one fund is going to have to pay the other fund back. Okay, so money is going to be paid back. So in this little example that I wrote up here, for example, interfund loans. On the balance sheet, the general fund is loaning some money, I'm assuming, to the capital project fund. Okay, and so on the balance sheet, we would have a debit to loan receivable for the general fund, a credit to the cash, as that cash is going out of the general fund into the capital project fund. Debit cash, credit the loan payable. Now that's considered reciprocal transfer because, hey, eventually the capital project fund, maybe when they get some funding in from a bond or something, should kick that money back to the general fund. Now, when you take a look at interfund transfers, those are considered non-reciprocal. The general fund in this example is going to send some money out, and I think in this example, I use the debt service fund as the receiving fund. Okay, so in the general fund, oh no, I guess I'm using the capital project fund. Okay, that's okay. Capital project fund is the receiving fund, not the debt service fund right here. I wrote capital project fund, John, right there. Okay. So what happens in the general fund, we would debit other financing uses, transfer out. Remember, other financing uses shows up what? After we have shown our revenues and expenditures on our statement of revenues, expenditures, and change in fund balance. Remember, we have what? Excess or deficiency of revenues over expenditures. And then we'd start having our other financing sources and uses that would be listed sort of like in the non-operating section of the statement of revenues, expenditures, and change in fund balance. So for our general fund, we would debit other financing uses. That would be a transfer out. We credit the cash that's going over to, in this example, capital project fund, maybe the debt service fund. often it happens that the general fund sends money to the debt service fund to service principal and interest payments on debt, but whatever, we'll use capital project fund as our example. The capital project fund will debit cash and credit the other financing sources transfer in. So on the capital project fund statement of revenues, expenditures, and change in fund balance, they would be showing another financing source, this transfer in, and next to that, they might actually have some bond proceeds that had come in for the period as another example of long-term debt financing that shows up on the governmental funds statement of revenues, expenditures, and changes in fund balance. In this case, we're considering the capital project fund. Okay. Okay, good. Now that's a non-reciprocal transfer because the idea is, hey, the money's not coming back. That's why we're reporting it on the operating statement as a reduction ultimately in the fund balance of the general fund and an increase of the fund balance on the capital project fund because there's not going to be the money going back over, in this case, to the general fund. Now, another example of a reciprocal, so we had the loan. Another example of a reciprocal transfer, if you will, would be if there is, say, a service that is provided by, say, the internal service fund for the general fund. The general fund is going to pay for that service. Maybe we have a central motor pool that is going to go ahead and work on all the city vehicles and whatnot. And when that work is done, they bill the general fund for that, and then the general fund will pay that bill over to the internal service fund. So if that's the case, in the general fund, there will be a debit to expenditure for, say, I just made the amount up, $5,000. They would credit, and I say due to internal service fund, but it could be an enterprise fund that is somehow has provided some service to the governmental unit. So it's not limited to an internal service fund, but we go ahead and credit the due to, and then in the internal service fund, the proprietary fund, we would go ahead, or the enterprise fund, we would go ahead and debit due from the general fund and credit revenue. We'll look at internal service fund accounting later. Sometimes that revenue account is called billings, but it is revenue, and it's more of an exchange type process. This is considered a reciprocal transfer because what? The money's being transferred over, but in exchange for some service that was provided by the internal service fund. Okay, so again, reciprocal transfer, loans, right? Charge for services, okay? And then non-reciprocal are really our transfers. Okay, just some terminology there. Okay, good. Now, if an encumbrance is still outstanding at the end of the year, then we're going to have to go ahead and close those outstanding encumbrances and ultimately make a closeout to our fund balance to show that there is some constraint on our fund balances for outstanding encumbrances. Okay. Now, closing entries, we will use closing entries to close our budgetary account, close our real accounts, close those out to our fund balance. And then if there are appropriate restrictions, constraints that need to be shown, I shouldn't say restrictions, because restriction is a category of constraint. If there are certain constraints we have to show, then we would go ahead and show those appropriate constraints. Okay. And so let's go ahead and let's look at this example that I do have posted on e-learning as well. And I've done it outside of the slides. It was just sort of something I made up that I think was a little more comprehensive, so we could kind of get sort of this, instead of this bits and pieces approach that we're using with the slides here, we can actually look at this more comprehensive example. Hopefully that will open the way I want it to. And again, this is a little bit hard to read, I guess, on your screen. So if you're, looking at the tile of the whole class, which you may want to do is slide that all to the right so that your screen is more taken up by what's on my screen here, so you can see it appropriately. Okay, so I'm going to go ahead and I'm just sort of made this up to sort of illustrate more of how the whole process of closing and whatnot would work. And so we have this estimated revenue of $2 million. We have appropriations of 1.8, and we have budgetary control credit of 200,000. Now I do want to keep track of my budgetary control here. And so I think the best place for me to do it, if Excel cooperates with me, because sometimes it likes to fight with me, would be maybe to just tee it up right here. And I'm going to call it Bud Control. Let's see if I get away with this. By getting away with it, I mean the computer not flipping out on me. Okay, so I'm crediting that budgetary control for what I anticipate is going to be my surplus, right? Of 200,000. Okay, good. So I go ahead and I do that. Well, I credit revenue because I think I'm going to have, yeah, no, I'm sorry. Budgetary control, 200,000. Sorry, guys. Okay, again, that's that 200,000 right there. I'm just posting it down there. Okay, you see what I'm doing. All right, good. So then I sit there and I say, okay, right? Okay, John, we get it. Okay, then what? Then, and just to make this simple, I'm going to have them collect this amount of revenue that they budgeted for. Okay, so we go ahead and we debit cash. We credit the revenue 200,000 when they collect the revenue during the year. And I'm going to just do that in one big chunk because I'm really focusing on the encumbrance and the spending process here. So we go ahead and we order some equipment. And when we order the equipment, okay, we have encumbrances of 1.6 and we credit budgetary control for 1,600,000. Okay, and we're doing that saying, okay, yeah, we ordered this stuff. It should cost us 1,600,000. Now what happens? When the stuff comes in, okay, and I'm going to go ahead and I'm going to also tee up my encumbrances here. Okay, and when I do that, I debit the encumbrance for 1,600,000, right? Just posting. I'm not going to always draw the arrow over. I think you can see that I debited encumbrance there, and I what's up there? Debited the encumbrance, and I just posted that down here, right? Okay, then 1.1 million of the equipment ordered comes in. And I ordered it 1.1 million, but it came in at a different amount, 1.3. So at that point, I go ahead and I debit the budgetary control for the 1,100,000. Okay. And I credit the encumbrance 1,100,000. Yeah, 1,100,000. Okay, now, as you can see, right, obviously, there's still 500,000 left as a balance here, right? I'm just looking at the difference between debit and credit. And so I still have this balance sitting here of 500,000, which I noted right there. And then I debit expenditure for the actual amount, 1.3 million, and I credit the cash. Okay. Now, that's the only things that happen. I set up the budget. I got some revenue, it's cash in. I spent some cash coming in on equipment coming in. Okay. So what happens? Now I start to make the closing entries and I simply reverse my revenue I credited it there. So now I'm going to debit it here for 2 million. I close the expenditures that I had debited here for 1.3. To close them, I credit them 1.3. and I have an unassigned fund balance of 700,000. Now I'm going to go ahead and tee up my unassigned for now. For this 700,000. But I need to do some different things now with the unassigned fund balance because not all of it is unassigned. I have made some commitment for those 500,000 of stuff I ordered that's still outstanding that hasn't come in to the encumbrance. Okay, right there. So what I'm going to do is I'm going to go ahead and debit unassigned fund balance for 5. Post that. Thus leaving me what? 2. Okay. And I'm going to credit assigned fund balance for 500,000. I'm not going to tee that up. Now, at this point, maybe assigned is appropriate. Maybe committed is appropriate. Maybe restricted is appropriate. It really depends on the level of constraint that's associated with these encumbrances that I've made. And we're going to go ahead and take a look at what it says in the notes of the financial statements for city and county to see how they've described what the amounts of outstanding encumbrances might constitute. Governments are not required to tell you, hey, this amount of assigned is for outstanding encumbrances, or this amount of committed is for outstanding encumbrances. They just have to show you the total that's assigned, the total that's committed. And then when we look in the footnotes, they describe the nature of things that I saw in your annual comprehensive financial report. It just sort of generally described the things that could constitute the assigned, the committed, et cetera. And we'll look at that here in a minute. So at this point now, I've assigned some of my fund balance for this outstanding encumbrance. I still have an unassigned of what, 200,000. I also want to close my budgetary accounts. So I had set up my budget at the beginning of the year. Okay, by doing what? By crediting the appropriation and crediting budgetary control and debiting the estimated revenue. So I'm simply reversing that entry that I had set up at the beginning of the year. I'm reversing that out now. So when I do that, that 200,000 that I had put in to budgetary control at the beginning of the year, I'm now taking it out. So now if you do the math on the budgetary control, we have what I didn't do this in the order I wanted to do it. So that's making that more difficult on me than it has to be because I'd written it all down as I went before. That should leave me, what are you seeing as the balance here? Is it 700,000?
Excuse me, I think there was a typo. It should be 1,600,000 on the right side.
Thank you. What's the balance now?
500K.
Yeah? Thank you. So now there's 500,000 sitting in the budgetary control. I've closed the budgetary accounts. They're all closed out. And now I can go ahead and close that encumbrance. Okay, so I missed closing that encumbrance by debiting, that's the outstanding encumbrance, by debiting the encumbrance, debiting the budgetary control, excuse me, for 500,000. That closes out budgetary control. It's now 0, and it should be zeroed out by the end of the year, the budgetary control. Thus, my point is just sort of a temporary holding place. And then I credit the encumbrance. So the encumbrance is now closed out. That's 0. That encumbrance is closed out. So I closed out the encumbrance. I closed out the beginning entry when I set that up, and I now have my unassigned fund balance of 200,000. I have the amount assigned of 5. And so if I were to look at the financial statements now, we have what? We have revenue. That was our 2 million of revenue. We have our expenditures. The change in fund balance is 700,000. I'm assuming we started with a 0 fund balance. The cash that's left is 7. I got 2 million in cash. I spent 1.3 on the stuff that came in. I don't have any liabilities. The unassigned fund balance is 200,000. That's what was left in the unassigned after I went ahead and made this adjustment. And then the assigned, and I didn't tee the assigned up, but I assumed that it was assigned the 500,000 that I had put in here. And again, depending on the nature of what's being set up right there, that 500,000, depending on the nature of the commitment, the constraint, not commitment, then that could be assigned, that could be committed, etc. Okay, so primary takeaway here is what? Is that we have these amounts come in, we prepare our financial statements, we close our budgetary accounts, we close our actual accounts, and we then prepare our balance sheet accordingly based on what's left in the ledger accounts for our balance sheet at the end of the year. And we close all our proprietary accounts, our temporary accounts, and we close our budgetary accounts, which the budgetary accounts line up with our temporary accounts. It's budget. We budget the revenue, we budget the expenditures, right? And we use that encumbrance process to make sure that we don't overspend. Question. Okay, now we have this issue of that 500,000, and the question is, well, what happens when that other stuff that we ordered of 500,000 finally comes in? In this example, I'm going to assume that it doesn't come in until the next year. Okay, well, what we would do is go ahead and reestablish the encumbrance. Okay, but now we're reestablishing the encumbrance for the amount that we ordered it for. So we debit the encumbrance, credit the budgetary control, and that's putting that encumbrance up. And this is now another year one's budget authority that we're reestablishing an encumbrance for. Since we are reestablishing the encumbrance, we don't need to put that in assigned fund balance anymore. So we take it out of assigned and put it in, out of assigned and put it into unassigned again. And then I say the goods come in, and I'm saying 2014, that next year, whatever, for 550,000. Well, then we go ahead, we close the encumbrance out for the actual amount. So that encumbrance for that item is now for those things that we ordered in year one, whatever, 2013, this example, in year one, that's all gone now. We've satisfied all those encumbrances. And then when we list the expenditure, since that extra 50,000 now is really coming in under, I'm assuming here, under another year's budget authority, we would go ahead and show on our statement of revenues and expenditures to change fund balance the relative years to which those expenditures were made. So 500 came from the 2014 budget authority, and the remaining 15 now is coming from the 2015 budget authority. Of course, we credit the cash for the total 550,000 that we spent on this thing. And we're probably okay with that per maybe Min's, was it Min's point, or maybe it was Marikar's point before. We do have some budget authority left over, don't we, from the previous year? Because remember, we had that 200,000 that was basically a surplus that was left over. So it's okay that we're spending a little bit more into that next year, but we're spending 500,000 from the previous year's budget authority and 50,000 from this year's budget authority. Question. Okay, now the other thing that, oh, before I do that, let's go over to, okay. And we can see deposits and investments with city treasury, that's cash. Essentially, we can see all the receivables. Notice we are using the term due from here, okay? Due to, due from, due to. So we talked about our deferred inflows. Notice the categories of fund balance, non-spendable, restricted, committed, assigned, okay? And then what I wanted to do was go over and take a look at page 63, which is actually page 49, but the way the PDF works, it's page 63. And they start talking about the different fund balance accounts, okay, the different constraints on fund balance, okay, non-spendable, okay. And here it says they're not in spendable form. It includes things such as prepaid amounts, as well as certain long-term receivables, etc. Okay, I don't see any call out of inventory. I'm going to show you an inventory example, but it doesn't look like it might be particularly relevant because I didn't see inventory listed. Although I did see other assets, which made me wonder, well, could that be some sort of inventory items? I don't know. It's not something that I can glean from this. But when you take a look at the assigned, okay, let's take a look at assigned. Includes amounts that are classified, not classified as non-spendable, restricted, or committed, no kidding, but intended to be used by the city for a specific purpose. Intent is expressed by the supervisors, etc. Now, when you look at is it committed or restricted here? Well, let's just read this. Committed includes amounts that can be used for specific purposes. Commitments may be changed or lifted by the city taking a formal action. Okay, let's look at restricted. Restricted includes amounts that can only be used for a specific purpose due to constraints imposed by external resource providers, by the city's charter, or by enabling restrictions may effectively be changed or lifted only with the consent of resource providers. Okay. I'm looking to see what it says. Oh, here it is. Hello, encumbrances. Yeah. Down here, I knew I'd read something about encumbrances, so it's right here. Let's highlight this. The city establishes encumbrances to record the amount of purchase orders, contracts, and other obligations which have not been fulfilled, canceled, or discharged. Encumbrances outstanding at year end are part of the restricted or assigned. Okay, so in the example that I gave, I put in assigned. Some entities may put some of that in constraint. Some may put it in restricted, depending on the nature restricted. Some may put it in committed, depending on the nature of the constraint. And that process of putting it into that would be taking the outstanding encumbrances and making sure that they're closed out appropriately to the appropriate category of fund balance. Question. Okay, so for kicks, I went ahead and did an inventory example, even though I don't see any inventory on your report. I thought it might be useful to run you through some of the inventory accounting here. So looks like I'm gonna have to go to a different file to find that. I should go. Sorting, let's see. Maybe not. Here we go. Okay, so let's go ahead and let's take a look at example of inventory. Okay, and guys, even though I'm showing you the purchase method and the consumption method side by side here, I'm going to just focus on the purchase method on this tab, and then I'll show you the consumption method over here in this other tab that you see here. So this will be the consumption method, the purchase method. Consumption method's actually talked about here. Okay. Now, under GASB allows governments to use either the purchase or the consumption method for inventory. Although they prefer the consumption method, they say, well, if you don't have inventory acquisitions that vary tremendously from year to year, go ahead and use the purchase method. Otherwise, you should use the consumption method, is basically what GASB says. Okay, so under the purchase method, let's look at that first. Okay, what a government does is they go ahead, and if we look at the balance sheet for both methods before anything has been purchased, we have cash of 100,000. I'm assuming all that cash is unassigned. Now they go ahead and they spend all of that cash, okay, purchasing inventory. And under the purchase method, they would simply debit expenditure for that 100,000, credit cash. The cash is now zero. We haven't made any adjustments to fund balance. So unassigned fund balance would still show 100,000. Don't freak. I know the balance sheet's out of balance, but we'll fix that before we go to year end and issue our financial statements. Now, if the entity uses 45,000 of inventory during the year, under the purchase method, no entry is made because they've already gone ahead and entered an expenditure at the time of acquisition. Now, when we prepare our statement of revenues, expenditures, and change in fund balance, assuming that was the only thing that happened the entire year, revenues would be zero, expenditures would be 100,000, and we would have a negative change in our fund balance of 100,000. Okay. Now, what we would do is go ahead and do our closing entries. So we want to close our expenditures by crediting those. When we close our expenditure now, just did I tee up expenditure? I did not. But expenditure would now be what? Would now be zero, right? Because we had debited it when we bought this stuff. Now, just to close it, we just credited it. So that's closed. And we would debit the unassigned fund balance. When we debit the unassigned fund balance, it started out with 100,000. We post that debit to unassigned. So that is now zero. Okay. But now we have to show that we have inventory. We'd have to count up our inventory, see what we have left. We spent 45, we have 55 left. So we go ahead and under the purchase method, we would need to establish an asset for inventory by debiting inventory. And if you have inventory, inventory is not in a spendable form. So you'd have to show that constraint on fund balance of being non-spendable. So we would go ahead and credit the non-spendable fund balance for 55,000 and debit the inventory. And when we do that, now our what? Now if we look at our T accounts here, our unassigned is zero. Our non-spendable fund balance now has a credit balance of 50 and the inventory is 55,000. Thus, our balance sheet now balances and shows that we have inventory. All of it is considered non-spendable. Now, that's under the purchase method, which GASB allows. But they say, hey, we'd really rather you use the consumption method, but you can use purchase method if it's not going to be materially different in the amount of inventory you use up year to year. Under the purchase method, Okay. And what I'm going to do is I'm going to set up my inventory when I purchase the item. So I debit the inventory, I credit cash, much like accrual accounting. And I'm going to adjust my fund balance appropriately as I purchase and end up using this inventory. So now I go ahead and I debit the unassigned fund balance for 100,000 and set that all up as non-spendable because it is all in the form of inventory. So now my unassigned fund balance is 0 and my non-spendable is showing 100,000. My inventory is showing 100,000. Okay. Then as I use the inventory, I debit expenditure 45. I credit my inventory for 45. When I do, my inventory is now showing what? 55,000. And I adjust my fund balance by debiting the non-spendable for 45 and crediting unassigned, excuse me, for 45. And so now my non-spendable is showing 55. My inventory is showing 55, and my unassigned is showing a positive amount now, a credit of 45. But I have to close the expenditure. So when I go to close the expenditure, I credit the expenditure, I debit the unassigned, and now the unassigned is 0. So when I prepare my financial report now under the consumption method, which you do have to go back to that slide to see that, my revenues are 0, my expenditures are 45, my change in fund balance is a negative 45. And as I've already stated, my balance sheet looks the same under both methods with inventory 55 and non-spendable 55,000. I didn't see a call out as we saw when we looked at the financial statements and the discussion of fund balance. I didn't see any discussion of inventories. Do you all have inventories? Maybe it was something that was not material enough to call out in the notes here. Do you deal with inventory at all? Do you use the purchase consumption method? I didn't see a specific discussion of that, although that doesn't mean it's not here. It's just I didn't see it. That's a question.
Yeah, it's Carmen. It is immaterial. Actually, for a while, we did have an inventory, prior to this year. But, we no longer, it is immaterial, so we no longer, carry it on the balance sheet at all.
Okay. Yeah, okay. And that makes sense because, especially if it doesn't change year to year, it's much ado about nothing to go through all that, as you can see. But I thought it was worth talking about in case you run into an exam that you're taking somewhere and somebody decides that it's worth asking you that. Okay, good. So that's pretty much the slides, guys. Let's go ahead, if there are no questions on any of that, and let's jump into the practice exam for 4B. Okay. So, and by the way, guys, questions 1 and 2 are the same question. Somehow I got them in here twice, got it in here twice. So let's just start with question 2. It's the same as question 1. The city of Kent's police department needs a new police car. A police car is ordered at an estimated cost of $34,000. An appropriate budgetary control account is made. When the car is received, the actual cost is $35,000. Which of the following is part of the budgetary entries to be made when the police car is received? Now, my advice, if you're ever being tested on something like this, is never fall for a test question that brings you in the middle or the end of a transaction and ask you, okay, what should you be doing? That's not your training. Your training as an accountant is, hey, first this happened, and this happened, and this happened, right? We have journals for that very purpose, okay? And so what I just went ahead did is I entered it for the entire transaction as described in this question. Again, 1 and 2 are the same. So I go ahead and when I order, I debit encumbrances, I credit budgetary control. When the goods are received, I reverse that original entry by debiting budgetary control, crediting the encumbrance, closing out that encumbrance for that item because it's here now. I don't need that encumbrance anymore. I close it out. I've got this stuff. And I debit the expenditure for 35 and I credit vouchers payable, or I could credit cash, whatever. And so what should I do when the car is received? Well, I compare what I've written down to the choices. When I received down here, I did what? I credited the encumbrance, didn't I? And debited budgetary control. I debited encumbrance for 34 when the stuff was received. You don't make encumbrances entries for the original amount. I mean, for the actual amount, you do it for the original. So I could have got rid of C and D immediately and then just realized by looking at this, yeah, I credit encumbrance. Question. This is something that we actually talked about, guys, in chapter 2, where we put different labels on our expenditures. Remember, we had program labels, we had character labels, etc. Okay. And remember, character told us the period of benefit for our expenditure. Remember, we had said that. Okay. So for this one, which is not a character classification, well, current means it's for current. Capital outlay debt service means it's supposed to benefit future periods. Activity is not a category that we put on our expenditures. And so activity would be the right answer because it's not a character classification. Okay. Okay, good. Number 4 here. A governmental unit uses encumbrance accounting. During the year, the government ordered but had not received a new police car. What effect will these events have on the unassigned fund balance in the appropriations ledger? Okay, so what I did was I made a little appropriations ledger. I assumed an appropriation of 100,000. Okay, I assume that a car was ordered and that the car ordered cost 45,000. So I debited encumbrance, showing that I had 55,000 left of encumbrance. Okay. Now that of appropriation that I could use here. Now, it wasn't asked here, but I assume that the car came in at well, let's just deal with that first. What if the government entity used encumbrance during the year the government ordered but had not received a new police car? What effect will that have on the unassigned fund balance in the appropriations ledger? Well, it's going to decrease it. Encumbrance decreases the amount of available fund balance in the appropriations ledger, right? Okay, because I haven't encumbered. I haven't, I had that money and now it's encumbered, right? Okay. Now, it wasn't asked in this question, but if the car actually came in and it came in at amount, and I just said, hey, we've been showing it coming in at more in some of the examples. What if it comes in at less? If it comes in at less, then you would do what? You would go ahead and debit the encumbrance for the the encumbrance for the 45, debit the budgetary control, and put in the expenditure for the actual amount. And now actually the amount of available encumbrance would increase now a little bit more. And I would still have this, I didn't do that right. It should actually, I don't know why I put 11,000 there. It should go from when I ordered the police car, it went to 55. So now I took out the 45, that put it back to 100, and then the 44. So it should be what, 46,000 now? 56,000, excuse me. I think I put 11,000 because I assumed they had ordered something else. But it would be 56,000. So we'd have a little more available now, but that's after the thing is received, which was not asked in this question. The balance is decreased by the encumbrance is the takeaway. Number 5, a public school district estimated revenues of 800,000 and approved appropriations of 780,000. Which of the following is the appropriate entry to record the budget? Guys, I always like to make my entries and compare them to the choices, okay? But I'll spare you that, and that we would debit estimated, credit the appropriation, and credit the budgetary control for 20. Again, when you look in the book, and that would be a surplus situation, when you look in the book, they may say budget, credit budgetary fund balance. I use budgetary control because GFOA seemed to think that that was a more appropriate account title. Okay. A county general budget includes revenues of 9 and budget expenditures of 8.9. Actual revenues for the year were 915. To close the estimated revenue, and what I did here is I just went ahead and said, well, look, I would have set it up this way. Okay, if I had estimated revenue of 9, I would have debited that, credit the appropriation, credit budgetary control, and then at the end of the year, when I go to close this, I simply reverse what I had originally set up. I mean, the way to look at this, these are what? Appropriation is like a spending account, and the estimated revenue is a revenue account. And so we're simply doing what? Closing out our proprietary accounts at the end of the year. Okay. So there's the correct answer there, credit estimated revenue. But notice I made the whole journal entry. Number 7, Carolina City places an order for a specific item of equipment and encumbers $6,000 for that item. The equipment arrives at an invoice price of $5,700. Which of the following entries should be made by the city upon receipt of the equipment? Again, I like to do the whole entry, the whole set of entries. So 1 in the order as they would have come up. So number 1, I would have debited encumbrance, credit budgetary control. 2, I would debit budgetary control and credit the encumbrance when I order the stuff. And then, when the stuff comes in, and this is the ordering. When the stuff comes in, I debit budgetary control, credit encumbrance, and I debit expenditure and credit voucher payable for the actual amount. So what should I do upon receipt of the equipment? Well, it's going to be this stuff here. But the way they kind of asked this in a testing type situation is they listed the debits and credits together to make it confusing. Okay, so I debit expenditure, yep. I debit budgetary control for 6, yep. I credit account payable, I called it voucher payable for 5,700, and I credit encumbrance, yep, for 6. Okay. Stop me if there's a question, guys. Number 8, a city uses the purchase method of accounting for supplies in the general fund. At year end, the amount of supplies on hand is material, and the city wants to report the inventory in its balance sheet. How should the general fund record the inventory? So if I had used what? The purchase method, I would have debited expenditure, credited cash or vouchers payable. Then as I use 45, I have to do what? I have to set up, that would mean there'd be 55 left of inventory. I'd have to debit inventory and credit the non-spendable fund balance for 55. So it is true that I would debit supplies and credit the non-spendable fund balance. And the little voice in my head is saying, who cares if it's not material in our world, then who cares what it is you do there? But if you ever did have a material amount, that's what you would do under the purchase method. Under the consumption method, okay, well, they tell us which describes the proper accounting for supplies in the general fund. And remember, GASB tells us we can treat it as either the purchase method or consumption method. In either case, material amounts of inventory are going to be shown on the balance sheet. Okay. And so if it was the consumption method, we would have debited inventory, credited vouchers payable. As we used it, we would have credited expenditure, debited inventory, and we would have adjusted the fund balance the way we saw in the little example I did as we used those items. In the statement of revenues, expenditures, and change in fund balance, a transfer received by the debt service fund from the general fund should be reported in the debt service fund as a what? Transfer in the other financing sources and uses section. That's below that item excess of revenues or deficiency of revenues over expenditures. Now, this question, again, when we take our little midterm together, guys, I'm gonna just give you multiple choice questions. But I thought this question was kind of fun, okay, in a way, for us to look at. So we have this set of information, and then they start asking us, hey, what are the journal entries that created these sets of amounts that you see here? Okay. So, for example, we have amounts estimated for our revenues, amounts appropriated for our expenditures. Well, let's just look at that right there. So I know that if that was the budget, then I had to make this journal entry down here, which was to debit estimated revenues, credit the appropriation 13, and credit budgetary control for 8. Okay. And then, oh, I didn't tee up budgetary control. Really? Okay, well, why don't I go ahead and do it? Why don't we do it just for kicks? So that I credited it for 800, right? Okay. All right, good. Then what? Then I go ahead and if I look at the encumbrance here, it tells me, hey, look, you encumbered, amounts encumbered, you encumbered 12.4. So if that's the case, then I must have done what? I must have debited encumbrances 12.4, and I posted that there. And I must have credited budgetary control for 12.4. Okay, I'm just posting that entry up there. Now it tells me then if I look, that's what I encumbered, but the estimated cost of the things, in other words, what was the encumbered amount for the amounts that I received was 10.9. So if that's the case, then it must be that I went ahead when the stuff came in, I debited the budgetary control for 10.9. And I credited the encumbrance for 10.9, thus leaving a $1,500 balance in there for the stuff that hasn't been received. And then they tell me in this table that the actual cost of those things that I received was 11.2. So I go ahead and I now record them as expenditure for the actual amount 11.2, set up the voucher payable. Now, I need to deal with the revenues, okay? The actual revenues that came in. And so they tell me that the actual revenues were 13,000, but it's net of 1% uncollectible. And so from our last discussion, remember we reduced the revenue by the amount we think we're not going to collect, and we set up an allowance for that. So I did a little algebra here. I said, well, if that's the case, 13,000 is 99% of whatever the taxes receivable were that were set up. So the taxes receivable must have been 13,131. We set up an allowance for the 131, and we would have, recorded the revenue net. So I can
Oh,
use
I have a
that.
question.
I'm sorry?
Oh, I have a question.
Yeah.
In the columns, there's encumbrance amount and estimated costs.
Yeah.
What is the difference between those?
Well, it's the key thing to look at here is the amount received. So estimated cost would have been the amount you encumbered for what you have received. So there's some amounts, that 1,500's left that you've encumbered for that you haven't received them yet. So I ordered stuff for 12.4, but I've only received of that total 12.4 encumbrance, I've only received 10.9 of that, but it had an actual cost of 11.2.
Okay, so the 12,000, I mean, the 12,400 is, um,
That's what I thought. That was everything I thought that was going to come in, right? So
okay,
far, what's come in at the price that I thought it was going to come in, I received stuff at 10.9, but it actually cost me 11.2.
okay,
So
so after the supplies come in, then so the amount of the supplies that come in is worth 10,900 of your estimate.
correct. And there's still 1,500 of stuff that I ordered that hasn't come in yet. And I don't know what the actual on that's going to be. Because it hasn't come in yet, right? I ordered 12.4 of stuff. And at what they told me it was going to cost me, 10.9 of that has come in. 1,500 stuff I haven't, that I ordered still hasn't come in. And the actual cost on that stuff was 11.12.
Okay, the 1112 was the actual cost of the stuff that came in. Okay,
Right. And there's still 1,500 worth of stuff that hasn't come in yet, but I'm not sure how much it's going to cost me yet, what the actual cost is going to be, because it hasn't come in yet.
okay, got it. Thank you.
Mhm. That was probably the tougher thing to figure out on this. This is obviously a test question. Okay. All right, good. So now I'm saying, okay, so 13,131 must have been the amount of the receivable because I recorded the revenue net of that. And so when I make that journal entry, I debit the taxes receivable, I credit the revenue, I credit the allowance. So I had to do a little algebra on that. Then the problem wanted me to do the closing entries. Okay. So for my closing entries, I reverse the original opening budgetary entry by crediting estimated revenue, debiting the appropriation, and debiting the budgetary control. Okay. So I went ahead and did that right there. Okay. So those are all closed now. I'm going to go ahead and debit budgetary control, 800. Okay. And then I went ahead and I want to set up the close that outstanding encumbrance. So I go ahead and I debit the budgetary control for 15. And I credit and I'm assuming here that, well, I want to close that encumbrance for 15. So when I credit the encumbrance for 15, it's now closed. So that's zeroed out. My budgetary control should be zeroed out. And then I want to set up an assigned fund balance for that encumbrance that's still outstanding. So I debit the unassigned fund balance, credit assigned fund balance, and then I go ahead and I close my actual accounts. I debit revenue, I credit expenditure, and I credit the unassigned fund balance. And so if you look at the unassigned fund balance, by the time we get to the end of the year, it is showing the 1,800, which is the amount that the revenue was exceeding the expenditures. I think I assumed a 1,500 beginning balance in there. Okay. Okay. All right, good. Let's see. Trying to see if there's anything else here that is particularly interesting. Yeah, let's look at this one, number 19. The following information pertains to Scott County General Fund, and the change in Scott County General Fund balance for the year. And so when we're looking at the fund balance, right, we would say, well, these appropriations and estimated revenues, they would affect budgetary control. What's going to affect fund balance is what? Is the actual activity, because we will close our revenues and our expenditures out to fund balance. And so if you look at this, the 14.8 of expenditures versus the 14.12 of revenues, we would have a $600,000 decrease, because all of that other activity associated with the appropriation and the estimated revenue, that's all going to affect budgetary control, right? Which will close everything out at the end of the year anyway. Okay, there was that one. Let's go ahead. We might as well go ahead, and we got time to look at these other ones. How should the general fund report acquisition of a new police car? That's expenditure, right? Modified accrual accounting. When Spruce City received goods that cost $9,700 that were encumbered in the prior year for $10,000, yeah, this is a good one for us to look at together. Which of the following entries are required, assume the encumbrance lapse at the end of the year? Which means we're going to close the encumbrance account the way we've been looking at. Now, they received at a cost of $9,700 goods that were encumbered in a prior year. So let's just look at that whole thing. And I think what I want to do for this one is, I think I can fit it in the margins. So year one, right? I might have to do a little abbreviating here, guys. We debit encumbrance for, we ordered this stuff for 10,000. We credit Bud control for 10,000. Now, the stuff doesn't come in, right? And so at the end of the year, we go ahead and we close that encumbrance. Credit the encumbrance. Right? And we go into year two. Now, when we go into year two, we go ahead and we reestablish that encumbrance, because we did order that stuff under last year's budget authority. And so we're just going to put it back in credit Bud control. Okay. Now the stuff comes in at 9.7, so it gets to be a little, back and forth here. We debit Bud control for 10, credit the encumbrance for 10, because the stuff came back, and we go ahead and we debit expenditure for the actual amount, 9,000. I don't know why I did that. That's a 9,700, and credit the cash or the vouchers payable, whatever, for 9.7. So after we look at all that, you look and you say, okay, yeah, we debited expenditure for 9.7. That's correct. We debited budgetary control for 10. Yep, that's correct. We credited accounts payable. I always use the term, I said cash, vouchers payable, whatever, accounts payable for 9,700. And we credited the encumbrance for 10. Okay. Now, this one, number 14, is a little bit interesting too. Let's do this one together. The city of Denton uses encumbrance accounting to control expenditures. If it charges the cost of outstanding purchase commitments to expenditures in the year they are received, not in the year they are ordered. Remember we said some might show on a budgetary basis what the actual expenditures were if stuff that they had ordered hadn't come in yet, but it was expenditure, but that was that budgetary actual on a budgetary basis column. But anyway, if the city had 11,000 of purchase commitment outstanding at the end of the year and received the goods during year 2 at a cost of 11,700, what would be the impact on total fund balance for year 2? Now, it's asking the effect on the total fund balance at the end of year 2. Now, in year 1, right, we would have set up the encumbrance, the budgetary control, when the stuff for 11,000, when the stuff still didn't come in, we would have debited the budgetary control credit and encumbrance, but we would have had to show a commitment to our fund balance for that outstanding stuff. So we would have debited unassigned fund balance. Unassigned fund balance, okay, that's unassigned fund balance for 11,000 and say assigned. Again, it could be committed, it could be, you know, even restricted, but I'm going to use assigned for 11,000. Now, what happens? In the year that the stuff comes in, now in year 2, in this example, we're going to do what? We're going to reestablish the encumbrance. And we have to take that amount out of the unassigned. I'm not going to show you the step of the encumbrance. I'm focusing on fund balance here. So I'm going to go ahead and I'm going to debit assigned for 11,000 and credit unassigned for 11,000. So reversing the year 1 end of the year entry to assign the fund balance for the stuff that hadn't come in, and now it really comes in. I would reverse the encumbrance. Again, I'm not doing the encumbrance here, but I would debit what? Expenditure for 11,700, and I would credit cash or vouchers payable, whatever, for the 11,700. Now, the expenditure is going to be reported on the statement of revenues and expenditures and change in fund balance as an expenditure. That reduces the unassigned fund balance by what? By 11,700. So what happened? Up here, all I did was what? Shuffle around inside of the total fund balance, but the total fund balance ultimately did what? Came down 11,700 in year 2 when we actually had the expenditure. Question.
I have a quick question. So this scenario is when the encumbrance doesn't lapse, correct?
Um,
Or I'm trying to link it to the other example.
yeah, I mean, I did it the same way from an accounting standpoint. I mean, I guess the way I'm doing it is a very meticulous way, I guess, of doing it for learning purposes. I guess if the encumbrance doesn't lapse, you could just leave it there and you don't have to close the encumbrance like that. But you would need to do the thing with the budgetary fund balance. I mean, not budgetary fund balance, but the unassigned fund balance versus the assigned fund balance to make sure you're showing the appropriate amounts assigned, right? Or committed or constraint or restricted, whatever it is. And you could leave that in the encumbrance. I just find it easier to kind of walk through the understanding. hey, take the out of the encumbrance account and then set it back up. If that requires new budget authority in that new year for outstanding encumbrances, so be it. That's sort of more of a mechanical process or more of a legal process. I'm just doing the accounting the same way in both cases, reestablishing the encumbrance, taking it out, closing it, and then reestablishing that next year. Regardless, if you did take it out and reestablish that next year, you'd want to keep, whether it lapsed automatically or not, you'd want to keep track of what budget authority that came under, right?
All right. Okay. So then, just trying to, we still would have to do for this year one, we will be debiting the unassigned and crediting assigned. Is that?
Yes, regardless, because you've ordered those things, right? And well, you ordered them. Oh, I see the question. Do you know, Carmen? Would you still assign the fund balance even if the budget authority had lapsed?
So, but I think for us, it wouldn't, it would still be a fund, because I don't think, we don't close it out like that if we expect that we're gonna get it. So, for us, and anyone else on this call could correct me if I'm wrong, I don't do a lot with the budgetary, but I'm pretty sure they just, if they're still there, they would roll forward. Unless we actually close them, they'll roll forward.
You'd leave the encumbrance open, then you wouldn't close it.
We're still expecting, if we're still expecting, we're gonna get them. We just didn't receive them yet.
Yeah.
Yeah, then the encumbrance would remain up. We don't normally close them unless we can.
Okay. So the
not-
encumbrances wouldn't be closed, but you'd still do the assignment of the actual fund balance, right?
Because we're gonna use, that would be the theory, that we're gonna use that money that's in there. We just haven't used it yet.
I'm having trouble hearing. I'm sorry.
Oh, sorry, yeah, that's under the assumption that we're gonna use that money for when we do get the goods.
Okay. Yeah, and then whether it's assigned or committed really depends on the level of constraints. So this part happens either way. All this that I did up here sounds like it doesn't happen because you've got that budget authority. It's not going to lapse, and so the encumbrance account can remain open, sitting there. I tend to like to close it all and reopen it all just so I'm kind of showing the way I present it. So you can kind of see how, okay, there is that encumbrance, and the rule is we close it and then we reestablish it in the next year, just so in all honesty, for CPA exam purposes, they almost always want you to close any outstanding encumbrances on questions. So that's why I teach it that way. But the reality is, I guess you don't, in your case, you don't close them. Does that answer? Who was asking that?
Thank you.
Yeah. Okay. All right. Good. Well, we're coming up on time. There are a couple of questions left that are pretty self-explanatory, guys. I'm not going to go through those. If you have questions on those, we can address them next time. What I do want to do, though, before we adjourn, is let's make sure we have an idea of where we're going here. Guys, there you are. So next time will be 7:27. And you can see we're behind. That's okay. So what we'll do next time, 7:27, next week, we will cover chapter 5 and maybe chapter 6. Going to just really depend on time. Okay. And then what we'll do the next week, 3-6, is we'll have well, let me ask you, On 3.6, would you rather jump into chapter 7.8, or would you rather do a prep for that class team midterm project? You don't have to answer that now. Think about that. Tell me next time. Okay, and I do expect to hear voices that will make me feel that I'm doing what the majority of folks want. But on the 27th, we'll decide if on 3.6, we definitely won't have time for chapter 9, but we may have time on the 6th to do chapter 7.8. Or would you rather do some sort of review of chapters 1 through 5 or 6 at that time, in anticipation of the midterm? I'm getting a prep. I'm starting to get prep, strong, emphatic request for the prep. So that's probably where we're gonna go, but let's see. Okay, and we'll expect to hear more next time. Okay. Any question, guys? Okay, another fairly productive meeting. Thanks for the hard work, and I will see you next week. Have a good evening.
Thank
Thank
you.
you.
Thank you, Professor.
Thank
Good
you,
night.
Professor.
Thank you.
Have a good night.
Good night.